Over the last 20 years, I've been fortunate enough to make a very good living trading just one stock pattern every day when the market opens. In fact, on most days, my trading is over by 8 o'clock in the morning, and I'm free to fill in the rest of the day with whatever I choose. I can ride my motorcycle, climb a mountain, spend it with my son. It really doesn't matter because that time belongs to me. And if you're an aspiring trader right now, it should be that way for you too, because you deserve to have a life that combines the perfect balance of both time and money. And I can tell you one thing, this stock market that we have right now, with the opportunities that are available right now, there's never been a better time, in my opinion, to achieve this goal. This is a new frontier we're on. There are going to be generational millionaires made in this stock market, and those people could be you. Now, in order to get you one step closer to making that dream a reality, I'd like to share with you a strategy today that's very close to me. And it's a strategy that I developed more than 18 years ago, pretty much out of necessity. Because just like so many of you, back in those days before I became a full-time trader, I had a full-time job. So I didn't have a whole lot of time to devote towards trading. I certainly didn't have a lot of time to spend in front of a computer all day. So I needed to have a strategy that could help me make the money that I needed to make right then and there, because I pretty much had no choice. So in today's video, I'm going to show you in detail everything I've learned about this strategy, and I'm going to break it down in just 3 simple, straightforward steps. You're going to learn everything from the setup to the signal down to the precise second you're going to enter this trade. And just to make sure that you fully grasp this strategy, I'm going to make a series of live trades in a live market. And that way, by the time this video is over, you should have the power and the confidence and the necessary tools to make the money that you need whenever you need it. So the strategy I will talk to you guys today about is something over time I have nicknamed the Eliminator, because that is the best word I can come up with, and that is the exact word that describes the core essence of the strategy. Because if you look on the screen, the Eliminator strategy's main goal is to eliminate the probabilities and the variables that come within a market, leaving you with what should be the best choice for you to make at that time. Now, you may have heard me say this before. It was a quote that I learned a long time ago when I started trading, and somebody had told me, our goal as a trader is not to predict the market. It's to align ourselves with the market. Maybe in today's age, you've heard a saying that goes, trade what you see, not what you believe. All of that is true. That's the main goal, is not to dispute what the market is doing, but rather participate within those trends and get on the right side. So here are 3 things that really are the foundational components of this strategy and how we're going to start with it. It begins with number 1, just looking at your daily charts. Just start with a daily chart. And I want you to map out the previous day's high and the previous day's low. Now, don't worry about internalizing all of this. I'm going to show you live examples and real charts. We're just getting the concept down. We're going to start with those because here's what we talk about when we talk about eliminating. No matter what it is you're trading, no matter what your strategy is, you tell me if you think it's different. But when you get up the next day to begin your trading session, there are only 3 variables that are available to you. 3 options. There's only 3 things that you will know for sure will happen the following day. 1, the asset that you're looking at gaps above in price above the previous day's high. Or number 2, it gaps below the previous day's low. Or it opens up dead center, or something we call inside. Now from there, I'm going to show you what you should do in most situations on a gap up, gap down, and dead center open. Remember, it's all about getting aligned with the market. So let me show you how we're going to do this right here on the whiteboard. Let's go ahead and say this is the previous day high and low. Now there's 1,000,001 strategies that have systems around the previous day's high and low, and it's always good to know those. But let's start with move number 1. If you, whatever you're trading, you get a huge gap up in the markets or a mild gap up or just a small gap. Let's just talk about a gap up. In most cases, I'm saying most, I'm going to use air quotes here, there are situations where the market does whatever the hell it wants. No matter who you are, how good you are, there's going to be 20%, 30% of everything you ever do and touch just doesn't work. That's sort of just the randomness of the market. So when I'm teaching a strategy, I want everyone to know the core principle is always something you can live the rest of your life with, something you can make a 20 to 30 year career with, not something that you can just get rich with in a bull market. So keep that in mind, and I'll show you some variations to that. Now, normally when this happens, the first move out of the open is a retest of that previous day's high. You can call it liquidity. You can call it resistance. Previous resistance becomes future support. You've heard probably of gap fill strategies, but out of the gate, that's normally the first move. Now, it may not end there. It may rally to the moon, but out of the open, that's normally what happens. On the inverse relationship down to the downside, if you gap down below those prices, typically the first move within the first minute is to try to recapture the previous lows of the day, making that the resistance. Now, it may go lower, it may go higher, but that's the first move. Remember, this is a specific time-based move that happens right out of the market open. And if you open up in the center right here, what will happen within the first 1 minute or so, that asset will try to make connection with the previous day's high, which in this case would be resistance, or the previous day's low, which will be support. Now from here, we have a plethora of options available to us, right? And the strategy that I'm talking about is very specific, that happens in the morning, but there's also other things that you'll see you can do later on. So what we want to think of is just this. Rule number one is if we gap, you don't want to buy the gap first thing in the morning. More often than not, you're going to pay for that. You do not want to short sell the gap at the bottom. And normally when you open up in the middle, you want to wait for this to either test the high, to test the low, and then gather that data to make a trade. Now, in my best estimation, before I move on to the trades, remember, I'm talking probabilities, I would say roughly 20% of the time throughout an entire year, you will get a gap up and gap down, one of substance, not 50 cents on a $500 stock. A substantial gap up, a substantial gap down will be about 20% of the behavior throughout the year. What you'll see 70 to 80% of the time in most situations is a dead center open. And there's a specific reason you see that open, because that is the most confusing spot for retail traders who use technical analysis to make accurate decisions. That is the best chart to screw people out of their money. Many of you may have remembered the box theory, right? What is the core of the box theory? Don't diddle in the middle. And before this video is over, you're going to realize by putting yourself in the middle, you're just writing your own trader death wish at this point, okay? So let's keep that in mind and now move to some live charts. All right, so on the screen, we have our gap up candidate for today, and it's none other than the thrilling and exciting Tesla. And for this, I'm going to be using the Tesla ETF, ticker symbol TISL, T-S-L-L. Sorry, I like to pronounce the ticker symbols. And also on the screen is a 5-minute intraday charts. Real quickly, when it comes to charts, it works for anything you've got, whatever makes you feel comfortable. 1 minute, 1 hour, 5-minute daily, doesn't matter. The concept and principle is the same. I just like to use 5 minutes. I was brought up on them. I just want to make that clear. That's irrelevant. Just follow the process of what we discussed on the whiteboard. Also, if you're unfamiliar with the Thinkorswim platform that I'm using, the dark black area is the market hours, the official market hours, and the gray area is post and pre-market. And here we are, pre-market, getting ready to open up. So according to the whiteboard, normally when you see this type of a move, the first out of the gate, this is very, very aggressive. So it's something that we have to handle with care, and we have to eliminate variables. So it's most likely in this situation going to try to pull in here or down at least into this gap to sweep that liquidity, because that's what stocks do. Now, there's something about this chart right now in the pre-market that's kind of leaning towards a potential trap situation that I want all traders to be aware of. You know, you always hear that classic word trap. What does it mean? It's a specific move that's set up to screw you out of your money. And here's how you know how that's done. I've taught this before in many different patches through my lessons, but recently, I'll put this video up here on the screen, I did something called the measured move. You can take any move that you see in succession and measure it and use that as a guide. So for example, if we go into yesterday, you'll see $20.60 and rallies consecutively to $22.60. There was a $2 straight unabated rally in this instrument. Doesn't matter what you're trading, that's your measured move. If you also look at yesterday, it starts out, it immediately retests the low of pre-market, gathers itself up early, and then makes a dash towards the top of that range. So we're working with $2. Now, this thing closed right here at $22.40. And if you look at where we are right now, we're at $23.68. So we're very close to this $2 top heavy range. So how I want you to think about it is as you get top heavy with range, it doesn't mean that later on it won't go higher. It doesn't mean the top is in and it's not a long-term buy. We're talking about trades and we're talking about probabilities and how we're going to make money. The worst thing you could probably do is walk right into the open because your risk and your reward under this scenario during this time is not favorable. Now, in really strong bull markets, like this euphoric market we have now, maybe you pull that off. But again, your body of work throughout the course of the year, if you try 10 or 15 of these, you won't even make it that far. You're going to get smashed because most likely it is going to come down into that liquidity before it goes higher. So if you want to buy, we want to mark our areas to look to get long somewhere in here if it's kind enough to give it to us. Now, if it impulses anywhere towards the open, based off of the range or getting into that $2, it would probably be a good idea, or at least entertain the idea of looking for a short sell to sell back in to this level or this level. Now, those are your choices. So let's get a little bit closer to the market open and take a look at what we have. Okay, now we're just a couple of minutes away from market open, and you can see that's probably already a short. That's a pretty aggressive pre-market move, but I would have liked to have been up here at the top. So what we're going to do here is re-strategize, and we're going to look at this top right here, 2370, and see if at the open there's any way this can get retraced. That's often what you have to deal with here. These things get very, very aggressive because I want to work off of this here for a potential stop loss on the short. But because this thing is so aggressive, definitely, and now if we do a smaller box, right, we're kind of dead center of this measured move of this range right here. So I don't want to necessarily get involved in that. But let's see. Let's try to monitor a bounce here real close. That's how it is sometimes. They get pretty aggressive and we have to re-strategize. Okay, so we got a spike here real early. This thing is super, super fast. I mean, it's jumping all over the place. It's maddening. Right here, 23.56. Let's try to get a cover somewhere down in to this range. But let's just discuss the anatomy of that trade. It's not that it's a bearish instrument, because it's not. It's the setup that you have, taking advantage of the pocket that you have. There were a couple of things that make this special. One is that gap up and the tendency that stocks and assets want to fill in gaps first. The second is the range of this trade. It is excessive. I wouldn't call it overbought, but in the short term, when you measure time versus price, when you get these rapid moves, I mean, look, it does it all the time. You get these very big peaks, these very big aggressive moves. It's not a stock that's for everyone, so you can use whatever you want to trade with this. But the point is, they typically fill in the gap. You have too much range, and the first move is going to want to come and get all these algos down here and then possibly rip. Right at the open, you got your answer. First thing right there, dive. not bearish, not a market crash. Just boom. They're going to take out those chasers. They caught them pre-market. They got trapped. Game over for those people. Their days probably went on tilt right there. Okay, coming back to visit this trade, it's a little janky moving around, but that's how these things are. Trade was still valid from the open. Let's see if we can grab somewhere around here, 2260. I think it's going to go right now. See if we can just buy that back right there. Okay, that's good. So 15 minutes right into the open. There's your payday. Now, maybe it goes lower, maybe it goes higher. But what I want you to understand is this. There's a reason this trade works and why it may look on the outside like, oh, I don't get it. Let's make sure everybody's on the same page. You can skip forward to the next one if you don't get it. There has to be a certain piece of context that goes with this. It's the gap up at the market's open. It's this gap up right here. And in your spare time, take these trades and study them, right? It's not bulls versus bears. It's you versus the market, you winning, you getting on the right side. The special part of this, again, was the gap up, little too much euphoria, and down it goes. That's just a process of markets. What goes up comes down. What goes down comes up. Now, if this didn't gap up like that, wouldn't be worth the time. If it gapped lower, we would have been looking to go the other way. If it opened up in the middle, we would have had to wait. But this is a perfect example to its maximum extreme how it works. So I believe we have what I would call right now our gap up candidate. It's not perfect true to form like I mentioned in technical analysis. We have to make adjustments. And the reason is because this market has been so bullish. We haven't gotten a whole lot of gap downs unless they were earnings related, and we don't want to be trading those. So what we have here is the closest thing I'm finding today is the Dow Jones, the YM futures. We got a nice opening flush. Now, it didn't happen pre-market, happened when the market opened. Again, we need to make adjustments. Same theory, same process, just a little bit of a delay. So if we go to the previous days, high and low, I mean, it's obvious we are way off of that in terms of highs and lows. And it gapped a little bit lower, right? Retested that gap and now flushed. So what we're going to be doing is looking to buy a dip on this. Going back to finding a spot where it matches on the daily or another area in the past, or we're using measured moves. So if you see each one of these moves right here, like let's go back into this area here, you'll see 44,700 to roughly 44,550. So you got these 150 to 250 impulses. So as soon as we've opened up, we've dropped here a good 120 points. So we're, again, pushing that range. And as we push that range, we want to look for, specific technical signals. Now, the one I'm looking here is probably going to be what you guys know as the John Wick. As you get into these levels, you want to try to find the buyer. So take a look at this candle as it busts through the low. There's already your big aggressive candle, a failed rally, and now a regular push. So just walking into this blindly is going to be a knife catch because we don't know if the bottom is in. So what I want to do is mark this candle right here because I know at some point this aggression is going to try to come back up to its starting point. Now, maybe this is the rare case that it doesn't, but based off the strong market, based off of our measured move, based off of where we sit with this, that's most likely the scenario. So what we need to do is find that. How I'm going to do it is any part of this candle, if we can stick 50% of that move, or if the next candle is green, that's what we're going to go for. That would give me enough courage at this point, and we have it. All right, I'm going to go ahead and go in it right here anyway. And the reason for that, again, a lot of this is experience. You will learn. I want you to focus on this candle. I'm going to try to talk quickly. This is setting up to be what I call the John Wick candle. It's the regular hammer candle. Just like these wicks up top. Wicks are my favorite trading signals because they signify an instant change. And see what happened? As soon as 50% of that, like this didn't retrace 50%. This was a very quickly retraced bounce. But this one, You got that candle and it came right in at the bottom, much like the gap open. What we're really trading here, if you haven't figured it out, is trap moves. Like the market, whether it's intentionally or non-intentionally, you be the judge, sets these traps for traders to panic. This is a panic candle. And if you can't build on panic candles, you typically get bounces. And look at it. There you go. You're starting to get a bounce in that area. Now, this is also a past support, which gives it a little bit more credibility. But point is the candle and the move. So think about what we have. Not quite like, again, not a perfect gap down because you just didn't wake up and see it. It sort of was a slow fade, and then it dropped immediately. Now, in a situation like this, let's say you don't feel comfortable with going in something like that. What you might get a lot here is you can wait for a little bit more for it to go green like that and just use a little bit wider stop. Or for the new traders, you want to manage risk just a little bit better. A lot of my trading now at this level is nuance and hunch based. I would say what you could do in a situation like this is just wait for a retest. See if this buyer is real. I mean, they're real, obviously, but like I said, with wicks, we've established in 3 different candles that there, in fact, is a very large buyer here. And if you can dip back into that, a buyer will be there. There will always be a pullback for a trade later. And let's see if we can just grab a really aggressive move, say somewhere about 50% of the candle. That would be all we're looking for here in terms of a scalp. So let's go ahead, come back here and see if we get this. Okay, just a quick update here. That's the area I'm looking to just get out of this. It's just a scalp. Not falling in love with this thing. There'll probably be a better setup a little later on, but the whole purpose of this video is opening scalps. Get me into the gray, we close. I think that's going to be good enough for me right there. Okay, so a nice little quick profit to add to it. Now, it might go a little bit higher, but in this case, I'm only after the scalp. Okay, now I'd like to talk about the opening in the center, which is what you will get most time. Again, air quotes around the word most. Markets are dynamic. They get crazy at times. Sometimes we impulse up, sometimes we impulse down. And for that, I have Microsoft, and unfortunately, I had so many things going on with other trades, I didn't get a chance to capture the entry, but I'm in here short, and I'll explain why and what we are doing here in just a second. But let me kind of back this up so we can focus on the pre-market. Then we'll take a look at the actual trade and all that good stuff. Now, some of you that's been around for a while, watch the channel, you're going to remember the box theory. You're going to hear some repetitive things around there. For those that are new, I'm going to put that video up here as well. Take a look at it. Explains a lot about these ranges. And we've just been on a rampant upward trend here, as I mentioned earlier. So if we go back and we look at Microsoft, it's just a simple strategy we've been using on all these. We mark the high, right? We draw that all the way out up here. Again, we don't have to be super accurate. We mark the low, and you'll see that roughly it opened up dead center, okay? And this is what you will get in most cases. Again, there'll be those rare cases, 20 to 40% of the time out of the year, that things will be differently, but for all intents and purposes, that's exactly what happens. Now, one of the most popular questions, I should say, that was asked to me when I talked about not trading ever in the center of the chart between the high range and the low range. And the reason, number one, it was called Don't Diddle in the Middle. And I want to kind of go over that because so many reached out to me and asked questions because that video is very popular. But the reason is you don't know which way that direction is going to go. So like if I were to ask you, what do you think this would do in terms of, this is pre-market, by the way, and again, I'm backing it up. So this is past tense, but what would the percentage be that it would go up versus down? I mean, I've been doing this for 25 years, and if you're traded here, I couldn't tell you which stood a better chance than the other, right? So in the pre-market, when you're opening up in the middle, that's not clear, and it's just a guess. And if we're trading off of randomness and guesses, we're just gambling, and that's what we're trying not to do. So what will happen in these cases is they will either attack the top of the range or attack the bottom of the range, okay? And we know that's going to happen with 100% guarantee. Now, for the trade I'm explaining under this particular scalping strategy, It's just two types of setups. You either parabolic impulse up into that or you impulse down. It has to be an open impulse. It has to be parabolic, supernova, whatever you want. It cannot be slow like this. It cannot be choppy. It has to make a run within 15, 20 minutes, maybe even 30 you could give it, but it has to be really impulsive. Now, if you're not sure what impulsive is, you can go back to the simple instruction of what I've mentioned before, which is called measured moves. I've said this before tons of times in this video. You can take the base of any move, right, in aggression, the very bottom, and measure it to the very top. That's the top of the range and the bottom of the range. So you have 440 here-ish, right? It doesn't have to be perfect. 448. You have $8 worth of potential range. So as always, this should be right on the top of your list for being a great trader. It most likely won't exceed $8 in a single day unless there's a specific catalyst to help it. And there isn't, right? It just means that's all you can really do in a single day. So as this thing moved up towards the top, I went ahead and I got a little bit of an extension and made a short. So what we would be looking for is extreme extensions or extreme drops. We would be then looking to take a variation of the gap up, gap down strategy and trade it back to the center, right? You want to trade it back into the center, right, of that range, because again, this is what markets tend to do. Now, if I scoot this back over, you'll see that's what's been happening here. It extended towards the top, right? And it's slowly working its way down in to the base of that range. Now, I'm just going to speed through this video because I've been at it long enough and I didn't get a chance to capture that. But that was the essence of that trade, and I'm still in it. It's just going to be something that's more to do with patience than anything else. But back to the principle here, that's what you're looking to do, is to reverse that trade. But it must be, again, our game is range, the speed and aggression of the move, that and the support and the resistance. It has to, touch that. That's your risk area. And then we're targeting back here. And sometimes they will actually give you a little bit more. So I hope that one made a little bit more sense. And my deepest apologies for not being able to capture that live. We just had a bunch of those other trades going on. So as always, I want to thank you guys for watching this video, and I appreciate your support. And I hope whatever I share with you can really get you to that next level as a trader. Now, before I sign off with today's video, I want to bring up a couple things I want you to just jot down, because some things are going to start changing towards 2025, and I want you guys to be a part of them. Number one, I just want to remind everybody that each week we produce a very extensive watch list of what we feel are the very best stocks to trade. We've seen some huge gains recently out of stuff that we've recommended, like Nvidia, AMD, the markets themselves, Tesla, Palantir. We've done both technical and fundamental research on it. So if you guys are just looking for great quality ideas that have mapped out buy and sell points, nothing else, then go ahead and subscribe to that. It is free. I keep reminding it's totally free. It's just something that we offer the trading community. I'm going to put, it's at therumors.com. I'm going to put the website down here. Just follow the link. It'll take you right to that. Again, it's free. Just sign up for it. Now, something I mentioned as well that I'm going to start doing at the beginning of the year, because I'm busy right now, but as this YouTube channel is growing, a lot of people are asking questions. And obviously, when I do these videos like this one, there's things I leave out. I can only stuff so much within a reasonable amount of time. And each one of you have specific questions. So I'm going to be polling those questions that I get in, like the most popular ones that are asked. And I'm going to do, like, let's say backup detail, like a backup video to this one to really re-explain it. Now, those videos will probably be a little lengthy, but they're for the people that really want to take this seriously and go to the next level. Again, that is also free. I just wanted to put that out there because we're going to start doing those things at the beginning of the year, and I want you to be a part of them. And remember what I said earlier, our goal is to teach you how to trade for the rest of your life. I don't care what you can do in a really good bull market. But can you make it in a bear market? Can you make it in a sideways market? Can you take whatever the market has to throw at you and become successful with it? And that's what we teach here. And that's what you have the ability to do. So I hope what we're doing is providing you with some value. So anyway, on that note, I'm done talking. Take care. Trade well. Until the next video, guys. Cheers.